Here's an investing strategy that got over 16% annualized return for the past 35 years. Let's see where this comes from. So the market has been experiencing significant volatility in the face of tariffs and growing uncertainty. Volatility can feel scary, but to the real investor, it means opportunity. It means more mispricings. And so how can we navigate these waters? We'll start with high quality businesses. So what does that mean? A high quality stock is a good company. It's a money printing machine. Let's take a look at an example. So a good company turns capital, equity, and debt into big profits. Invested capital, here $100 going into our money printing machine, our cardboard box that spits out goods and services, can produce at the end of a year, yearly profit, shown here as $50. It's the NOPAT, the net operating profit after tax, that we're interested in, but think of it as yearly profits. We can put these together to form a ratio, the ROIC, return on invested capital. The invested capital that goes in, and then the yearly profits that come out. So that would be $50 over $100, or a 50% ROIC. Sounds like a high quality business, but what are we comparing this to? There's another piece to the puzzle, the cost of capital. So that $100 that we raised in the beginning to go into our money printing machine had to be financed, raised through shareholders providing equity or debt holders providing debt. And so we represent the cost of that capital here as $10 going back to the shareholders and the debt holders. This allows us to form another ratio, the WACC, the WACC, the weighted average cost of capital. This is a simplified model, but in our case, it's $10 divided by $100, or a 10% WACC, weighted average cost of capital. And so we can define a good company very simply as one that has an ROIC above the WACC. This is a business that's creating value. It takes in capital, returns more than it costs to raise that capital in the first place. Let's take a look at a specific example. So I'm using ValueGlance.com here. This is our tool to analyze any stock by looking at the long-term trends. We can go over here to the Stocks tab. Let's take a look at Microsoft. And so what we're plotting here on the vertical axis is the ROIC. That's our key quality metric shown in blue. And in red, we're plotting the weighted average cost of capital. And we could see whenever the ROIC is above the cost of capital, by our simple definition of a good company, we have it shaded blue. We could go ahead and look at Microsoft over the long term here, going back years, going back decades. There's been ups and downs, of course, but we can see steadily over the long term, Microsoft manages to keep its ROIC above the cost of capital. By our simple definition, it is creating long-term value. What if we wanted to find stocks that were creating long-term value? We can go back over here. Let's take a look at the stock screener. Here in the screener, we can go to filters. And in this case, we'll just look at market cap and ROIC. So the market cap here, we can select in unit of billions, 0.1. So that's $100 million market cap up to the maximum. And ROIC, we can take 20% up to the maximum. We click apply. Here we're analyzing stocks in the New York Stock Exchange and NASDAQ, so thousands of stocks. We narrow it down to 318. So still not narrow enough. You can add in other conditions if you like, but just want to illustrate here how we can filter according to this key metric. If we want, we can go ahead and save this screener. Name it ROIC test in this case. And so that's great. Now we found companies that satisfy this condition of a high ROIC, at least for the latest quarterly data points. But how do we know that high quality companies that are printing value are actually printing value for our portfolio over the long term? So to actually test this strategy, we want to go over here to the backtester. This will allow us to test out this strategy over 35 years of real historical data to see if we beat the market. So to run a backtest, we can click Create New Backtest. And here we can look at presets or customize screener. So here's the one we want to look at, ROIC above 20%. We can rebalance the portfolio annually or quarterly. So that means every quarter or every year, we apply the filter, select, in this case, 30 random stocks that satisfy the filter, hold them for 1 quarter or 1 year, and then repeat that process. So constantly applying the filter, here going back to 1990. And I like to extend this to the most recent available quarter. So we can call that ROIC, whatever, test 2. Click Run Backtest. And now I already ran this in advance, so we can see the result here with the same filter. So we click on that. And here we have the backtest results. And the brown line here shows our strategy. So rebalancing every quarter. We could see if we click on it, we get a pie chart. And so this shows all of the different companies that we would have held. You can see the returns over here, the weight, so each quarterly return. But you see this S&P 500 line here in blue. Look how tiny that is. So we crushed the market over 35 years. And the reason that it looks like this is because it's on a linear scale. So I like to go to a log scale, and then you can see the vertical axis here. Shows it on the log scale. So 1, 10, 100, 1,000, much easier to see over the long term. We could see the SPY, the S&P 500 index here. A couple bumps, a couple bubbles there, tech bubble, housing bubble. But our high quality strategy here, we see returns over 16% annualized growth. So that turns $1 into over $200 compared to the S&P 500 over that same time at 8.5%, turns $1 into around $17. So this shows over the long term how a portfolio constructed following this strategy would actually beat the market over the long term, almost double the annualized growth rate. And so when you extend that out over 35 years, we get these great results. So hopefully this gives you an appreciation for why high quality stocks are a great strategy for the long term. They're money-making machines, businesses that can generate a return on their invested capital that's very high. It creates value above the cost of capital. But we see when we actually construct a portfolio with real historical data over the past 35 years, we crush the market. And this was, again, a super simple strategy that we use to filter. You can come to ValueGlance.com to test out your own strategies, or you can check out Stop Checking the Price. It's my book where we go into high quality stocks, how to analyze them, how to find them based on this sort of strategy. And with that, I wish you the best in navigating the hype cycles of volatility that we are all experiencing by finding these winning stocks over the long term.